I think this is where you go after sectors right now that have continued to defy either what people think are fundamentals, defy logic, or defy basically gravity. In the case of energy, you keep buying it. Look at those numbers you had out of OPEC in terms of production. It looks like OPEC, first of all, those are 4.5-year lows in terms of OPEC production last month. I think it's still the most shorted sector out there. It's not going to be something that necessarily you hang your hat of the market on, but there's places to invest. I also think that the industrials continue to get a reprieve, and I would be buying Europe, which is massively under.
So Tim brought up energy, which I think is a great point, because the dip you want to buy is when oil goes higher, people start worrying about, wait a second, the Fed's got to come back in because we've got inflation, because energy prices are rising, and maybe the economic news isn't that good, and the trade deal isn't as good as we thought. That's the dip you want to buy, not this particular dip. And the reason why is all those things will ultimately get fixed. The Fed will be on the sidelines. The trade deal will get something done there. And OPEC, it's fine to have high oil prices, but at some point they price their customers out of the market and they'll lay off. So I agree. I think you can buy energy here, but nothing else until you get that real negative dip.
I like a lot of these software companies that have pulled back. So we saw, Salesforce ahead of earnings pull back. And these software companies in particular, they really help businesses to become more efficient and more profitable. And at this stage of the game, late cycle, that's what businesses want to do. They want to be more efficient. They want to be more profitable. And these software companies, most of them are generating recurring revenues. And there's no revenue better than a recurring revenue.